Hello, this is Duncan McDonald-Korth, editor of the Oxford World Financial Digest. I'm here today as part of our weekly video recap series, where OxWFD brings you the top stories of the week and then gives you its insights and opinion on them. Well, it was another big week in markets. This week was really bifurcated. With the Fed on everyone's mind, the week was divided into pre-Fed and post-Fed. Markets were relatively quiet leading into the end of the Fed meeting, but on Friday things changed. To most people's surprise, the Fed delivered a thoroughly dovish speech and decided to hold rates steady near zero. Most were expecting a hawkish hold, so the dovishness came as a big surprise. The Fed did not directly specify China, but was quick to highlight the external risks to the U.S. economy. Only one Fed official voted to raise the rates at the meeting. On Friday, markets reacted strongly to this, with Europe falling mightily and the U.S. down 1.62%. The drop in the U.S. meant the market was broadly flat for the week, but with some downward momentum heading into this trading week. Interest rates dropped following the announcement, which is one of the only foreseen reactions to the Fed meeting. Oil bounced around like a pinball this week and finished the week up, above $46 a barrel. In one bit of geopolitical news, Greek PM Alex Tsipras managed to win a convincing re-election, with the ironic twist being that his new mandate is to enforce the brutal austerity he was initially elected to resist. It may mean smoother sailing in regards to Greece, however. So what do we make of all this? Firstly, on commodities. We think that a huge drop in commodities all over the globe was a signal that the economy was headed for the worse. In terms of oil, we think overproduction will continue to pervade the market, and therefore prices will stay weak. Some think a drop in capital flowing to U.S. oil will lead to legitimate production cuts. We're skeptical. We think the Fed's decision reinforced the idea that markets in the global economy are at a turning point. Growth is slowing, and deflation is creeping in worldwide. We fear that the global economy will slow, following emerging markets' lead, especially China's, and that the U.S. economy will likely sputter along for the foreseeable future, wounded by a stronger dollar and falling inflation. In terms of the market's mood on all this, Friday's reaction might prove to be a sign. Despite rates staying low, stock investors are no longer feeling jubilant, and we believe that far from the steady ride equities have seen over the last few years, we're entering a new period of turbulence. Best of luck to everyone, and make sure to join us next week.